Most business owners hear LLC or S-Corp, but they are not always clear as to what gets taxed under each one. So let's break down the difference between LLC taxation and S-Corp tax treatment by looking at what gets taxed, which tax rate applies, and why it matters. For the purpose of this video, when I say LLC, what I'm referring to is a single member LLC taxed as a sole proprietorship. So let's begin. When you have a single member LLC, the business usually reports its income and expenses on Schedule C of the personal tax return. The business makes money, subtracts expenses, and what is left is the net profit. The net profit is the key number. With an LLC, the net profit may be subject to income tax and self-employment tax. Federal income tax is the regular tax that most people are familiar with. It depends on your total taxable income, your filing status, your deductions, your credits, and the tax brackets. Self-employment tax is different. Self-employment tax is the Social Security and Medicare tax for people who work for themselves. For a W-2 employee, Social Security and Medicare taxes are based on gross wages. The employee pays 7.65% of gross wages, and the employer pays another 7.65%. However, when you are self-employed, you are responsible for both sides. So self-employment tax is 15.3% of roughly 92% of the net business profit. That is why LLC owners can be surprised at tax time. They are not only dealing with income tax, but they are also dealing with self-employment tax. Without year-round guidance on estimated payments and tax reserves, they can end up facing a tax bill of thousands of dollars, not expecting it, which leads to stress, frustration, and financial pressure. Now here's the part that many owners miss. Taking money out of the business does not reduce business profit. If you move money from your business account to your personal account, that is usually an owner draw, which for an S-Corp would be referred to as a shareholder distribution. An owner draw is not payroll. An owner draw is not a business expense. An owner draw does not lower the net profit. So even if you already paid yourself, even if you transferred the money, or even if you spent it, the business could still have taxable profit. So the tax system is not asking how much did he transfer to himself. Rather, the tax system is asking how much net profit did the business produce. For example, an LLC owner may have $40,000 of net profit at a given time. And at that same time, they may have $25,000 cash in the bank. So the owner decides to pay himself a $5,000 draw. That takes the bank balance down to $20,000. But what would the business net profit be? It'll still be $40,000. It is because an owner draw is not a business expense. You see, a single member LLC cannot pay its owner a wage. The owner is not an employee of the LLC. Therefore, he cannot take a wage. Rather, he can only take an owner's draw instead. So that is the LLC side. Now, with an S-Corp, an owner who works in the business is recognized as an employee for tax purposes. Now, this owner must receive reasonable compensation as wages, reported on Form W-2. And he also may take shareholder distribution. So these wages matter because wages are a business expense, but wages are also subject to payroll, which includes Social Security and Medicare taxes. So the owner pays 7.65% of his gross wages as the employee, and the S-Corp is also responsible for paying another 7.65% as the employer. So an S-Corp does not eliminate Social Security and Medicare taxes. Those taxes still apply to the owner's wages. But after the S-Corp deducts the wages and the other business expenses, any remaining profit generally passes through to the owner, subject to income tax, but not self-employment tax. That is the key difference from the LLC, where net profit is generally subject to income tax and self-employment tax. Now, do not misunderstand the strategy. An S-Corp distribution is not a deduction either. An S-Corp distribution is money the business transfers to the owner in his role as a shareholder. So a distribution may decrease the cash in the bank, but it is not a business expense. Therefore, profit will not reflect this deduction. Profit will remain the same. So here's the full picture. With a regular LLC, the net business profit is usually the number exposed to federal income tax and self-employment tax. The business earns money, subtracts expenses, and whatever profit remains is subject to not only federal income tax, but also self-employment tax. It is important to keep in mind that the owner draw does not reduce that profit. Now, with an S-Corp, the owner's wages are deducted before the remaining business profit is calculated. Those wages are subject to payroll taxes. The owner pays the employee's share, and the S-Corp pays the employer's share. The remaining profit passes through to the owner and is generally subject to income tax, but it avoids the self-employment tax. So an S-Corp is not about avoiding all taxes. or skipping payroll. It changes how much of the business profit is subject to Social Security and Medicare taxes. Instead, reasonable wages are subject to those taxes, while the profit remaining after wages is generally not. That is why the difference matters. So before choosing between the default LLC or S-Corp tax treatment, have the numbers analyzed. You need to understand what profit your business is producing, which taxes apply, how owner pay works, and whether the S-Corp tax treatment actually changes the result in your favor. I am Maurice Wally, an enrolled agent federally authorized to represent taxpayers before the IRS, and I'm also the founder and principal advisor of Meridian Advisors Tax and Accounting. If you want help understanding how your business may be taxed, text TAX to 954-406-9737. Thank you, and I look forward to hearing from you soon.